Well, when I think back on my years of investment, I think what I tell clients is I've lost money every way there is to lose money. You know, I've had opportunities to invest in the stock market, in real estate, in commodities, you know, businesses, and I think what happens when you have invested money and it's your money and you've lost that money, you learn a lot of things. You learn how to manage the risk, you learn what to look for, and as a result of that, I think you're a better advisor as a result of it. So I would never put a client into anything that I don't understand and totally appreciate, both from a risk point of view and from a management point of view. A lot of times I get asked the question, how do you invest? How do you think about money? And the answer to that question is you got to have principles. I mean, you've got to have clear ways of being able to understand risk and understand the principles that are necessary to be successful. So many years ago, I wrote a book called Baker's Dozen, 13 Principles for Financial Success. And in that book, I outlined 13 different things that I thought were important, like, you know, how to reduce debt and how to save money and how to pick an investment advisor, how to understand who you should trust and who you can't trust, and then I wrapped the book up with a whole chapter on, you know, what it really means to be successful financially, what financial success really means, and how to think about wealth and managing wealth. In my book, I have what I call the 3 buckets. And the 3 buckets are a way of diversifying money. So money pours from one bucket into the next bucket into the next bucket. And the first bucket's very conservative, the second bucket is a little bit more aggressive, and the third bucket is the bucket where people take a lot of risk. That's where they can hit a home run financially, but they can also lose money. What I've found is that most people want the best return they possibly can get, and so as a result of that, they invest in the number 3 bucket before they've diversified well in bucket number 1 and bucket number 2. And as a result of that, they oftentimes lose because they run out of time. And when you run out of time and you don't have any money, any reserves, any margin, then what ends up happening is you can't hang on to those investments. And so I call that greed. And the greed is that they want the best return faster than they can really afford to take the risk in order to be able to obtain it. So what I try and teach people to do is to be patient and to build up capital in their other 2 buckets. And then once they've got the capital in the other 2 buckets, then they can take the risk and they have the time. And I think back on investment mistakes. I owned a building that sat vacant for 2.5 years, and I had to liquidate bucket 1 and bucket 2 in order to keep bucket 3, that investment. And fortunately, I had enough there to be able to hang on to it so that we were able to rent it and make the project successful. When I'm talking to people about the buckets and I talk about greed, of course I don't want to make them feel shamed or scared necessarily, but I want them to understand the importance of investing long term and to be able to have enough margin. And so I do use the word greedy, but we usually talk about it in terms of, you know, more of a joke than anything else, because they will oftentimes say that most people want to invest in the number 3 bucket before they're really able to afford it. So it's more a matter, I think, when I'm talking with my clients, to get them to understand the principles behind that and why there's a problem if they don't follow those principles. If you think about a myth is when somebody believes something that's not true. And, you know, one of the things that I find is mythical is that people think that the market's going to go up and up and up and up, and then it's never going to go down. I remember one time we were doing enrollments for 401k plans, and we asked the group, you know, what do you think is a fair rate of return on your 401k? And they, almost to a person, said 12%. And of course, 12% is a very, very high rate of return, which was a myth. So we tried to show them historically where that was not true. But I think when you think about myths, what you really have to go back to is the principles that I was talking about and understanding the principles. And the principles kind of debunk what people oftentimes think and act upon. So if you can put that into action for them, like how to buy a house. And a lot of times they'll say location, location, location. Well, that's a nice thing to say, but there are a lot more important things than just location. And you've got to think about, for instance, the school districts, the property taxes, whether there's extra taxes on top of that, whether you want a cul-de-sac. I mean, so you may not be in the absolute ideal location, but you may have all the other factors. So it's a matter really of principles more than anything else.